Hello, everybody. Welcome along to another episode of Beyond Bitcoin. My name is Derek Graham, and as you know, we often get exceptional guests on this show, and we really are bringing these guests on with the view of having insight into the marketplace. You also know that our fund does a great deal of research into finding quality funds, institutional grade funds. Today, we have one of the outputs of those research, and that is we have Andrew Woodruff, who's the CIO of Black Lotus Capital, joining us. Hello, Andrew. Welcome along.
Hey, Derek. Thanks for having me.
Hey, Andrew, quick background, because it's quite an extraordinary background. You're a highly accomplished person, and you can see why you're running the likes of Black Lotus. So please tell us a little bit about your background and then how that might overlay into this space, because for the listeners, what does this mean in regards to the specialty and how you invest in this space? And speaking with people like Andrew, it gives great insight. Hey, Andrew, over to you. Tell us about how you arrived at this space and what your background is.
Sure. So I started off my career at JP Morgan, working in global emerging markets and a lot of different asset classes, which I think prepared us for some experience across different asset classes that, we can start looking at crypto and see how they compare and contrast. Got my MBA at Columbia, and then, ended up in the hedge fund world at a multi-billion-dollar hedge fund for about 8 years. Wow. Started my crypto journey in 2017. And, it started off as a hobby with a couple of our general partners, just meeting in our, apartments and just starting to do research on altcoins and just better understand the space. Ended up leading to doing it professionally at the hedge fund I was at. And it was through that process that, we met a lot of managers and other types of strategies in the space. But one of the things that really stuck out to us was there seemed to be an opportunity or a gap to fill of being able to create a more institutional grade investment research process and or risk management processes for institutional capital like the U.S. pension funds, endowments, and those types. And since we came from that world, we felt like there was an opportunity to adapt a lot of those processes we've learned to help meet their operational due diligence processes and everything to create something that was better risk managed and less volatile for them for this space. We're a long, short, fundamental-oriented hedge fund. We invest purely in liquid digital assets. We are very research heavy. We look at altcoins all across really the top 500 just based on liquidity. But our goal is to effectively, at all times, own a handful of longs that we think are, potentially the future Amazons or the sustainable ones that we think are going to make it and change the world in this space. And then we hedge out that risk by shorting a diversified basket of shorts that we consider the worst of the worst in the space. And that allows us to hedge out most of the volatility and drawdown risk and allows us to hold these digital asset altcoins that can go up 10x, 100x compounded over time without having to time it or get lucky with timing. So that's the premise of why we started this and, all of our processes and strategy around it.
Yeah, look, I've often said before that we've done a good deal of research as a fund of funds, seeking high quality funds, both in the fact that they're institutional grade, which broadly means that they have independent auditors, administrators, CIOs, CEO, CTOs, etc. And they are very focused on counterparty risk and managing that, because that is what we would consider to be the greatest risk of this marketplace, permanent loss through counterparty failure, exchanges, etc. And you've clearly navigated that route, and you're at that standard. And then on top of that, you've then turned around and said, all right, we know this market is volatile, but we also think there's some great winners in it. And how do you not just ride the market? It's quite a fascinating investment thesis, because if you look at a dozen, and we've graphed them, a dozen or so of the major fund managers in this space, and you look at their graph over the last 4 years, assuming they've got that history, then you see that the majority of them just track each other. They're just tracking the sort of the beta of the market, but hoping to get slightly higher alpha out of the volatility. Of course, what I mean by the beta of the market is simply the direction the market goes versus the alpha, which is the difference, the excess return of the investment compared to the benchmark. And, these funds have big investment teams, et cetera, but they're not doing, many cases, outstanding theses. Yours is. You're looking at turning around and saying, we want to deep dive invest, finding the next Amazon. But importantly, we're not going to just ride the market, we're going to sell the shorts. So can we talk a little bit about how you navigate and sell the shorts without saying names? Because the minute we say names about a short, everyone seems to get emotional. Seems to be filled with tribal behavior, this space. But talk about some of the shorts and what makes them shorts. And then let's hear about some of the really special tokens, what you think they are and why they're special. Andrew?
Yeah, so the whole idea of the short selling process was honestly, what are the highest correlation hedges we can get to these, altcoins on the long side, which, generally speaking, altcoins are more volatile than Bitcoin. And, we have a pretty long, robust background in short selling research and everything back from our TradFi days and stuff. And we adapted a lot of those frameworks for this space. One thing that really stood out to me, even back years ago when, talking to a lot of our manager friends, is everyone told us short selling is crazy. If you believe these assets can go up 10x, 100x over, time, why would you ever risk shorting anything like that and put yourself at risk? But the other kind of thing that stood out was almost every manager and anyone in crypto who's been in this space long enough, most of us believe that most digital asset tokens are worth nothing, that most startups, even outside of crypto, fail, and that's no different than any other competitive asset class or market out there. So we all agree on this stuff, but yet nobody wants to short and take advantage of that over time. And if you look at the top 500 from 2017 in market cap rankings, it looks very different than the top 500 today. We forget the names that didn't stick around, right? So for us, it was, how do we build a short portfolio to hedge out our longs that we could hold through every bull and bear market cycle, every short squeeze, all that stuff, and effectively benefit from the hedging over the short term, any sudden beta drawdowns, black swan risks, you name it, and benefit from that. But throughout cycles, these are the assets that we believe are going to severely underperform the longs and underperform Bitcoin over time. What does that look like? Most of these shorts, they generally don't have any competitive moats. It's, they're doing the same things that everyone else is doing. They're not the leaders in their sector or in the product that they're doing. They usually have low float, high FDV, profiles. And we all know that most of these VCs that, once their unlocks or their vesting starts, they auto dump these things. I don't think that's a secret at all, right? They've already made their money. And so that's why you see a lot of these low float, high FDV tokens just continue to underperform over time. Now, there are exceptions to that. That's why you still have to do the bottoms up research. That's why you still have to understand, what's actually going on and driving value in these tokens. But generally speaking, that's the profile of most tokens we look at. It's easy to find shorts. It's much harder to find what we think are good sustainable longs. And so that's on the short side. On the long side, we break it down into three kind of core areas. We're looking for projects that have digital asset tokens that we believe have a clear path to sustainable competitive moats, widespread adoption, and token value capture. Most of these venture projects don't meet that today. These are venture assets, they're early stage, so you have to think a little bit like a VC and track it over time. The good thing is, since we are a liquid portfolio, we can track these things and change our mind and sell out of the token if things aren't tracking the way we would like it to be, unlike VCs that are obviously more locked up for a longer period of time. But these are assets that we think institutions will own because they're actually going to create revenues or drive value to the token holders over time in a sustainable way that effectively will make their tokens, for the most part, net deflationary rather than inflationary. And if you can find those gems and you can, track them appropriately and everything, and then have your hedges on at all times, we simply just make alpha between the longs and shorts performance, over time. And that's, we're a hedge fund. The word hedge is in there. We believe we should be hedged at all times. Risk management is our first and foremost, priority here. The longs allow us to compound something. If we do hit an Amazon, we can still get the same returns as, let's say, a VC, portfolio, for example. but without taking any of the short-term market drawdown risk that, other maybe liquid directional funds or VC funds have to endure based on their strategies. So hopefully that's helpful.
Yeah. Look, it just goes to show you the quality and the consideration of your thesis there, which is commitment into the space, but at the same time with the understanding that things change and there are pivots that happen in this space very rapidly. Andrew, you talked of the 2017 top 500, even the top 30, frankly, being very different to, the 2024. And as we all know as investors, the Fortune 500 companies are massively different to they were than the 500 also. It's just over a longer period of time that you see these substantial changes occur. And so this space is, as I've often said, it's Darwinism on steroids as it rapidly grows and creates this extraordinary totally new asset class, new economy that it's creating. But you guys have turned around and acknowledged that it's moving fast, and you've worked out a system that is able to cope with those fast moves and also committing into the space at the same time. Now, the space is moving, as I said, and we're seeing meme coins come onto the space. And, we know that meme coins are less than 3% of the total capitalization of the market space. The turnover is great, but it's a punting environment. Andrew, do you think that's changed how some of these shorts that you're talking about, these ghost ships of blockchains and things that are no longer really having a reason for being that people used to punt on, do you think the meme tokens are going to impact those shorts, and in what way?
Yeah, so one thing we look at, and we've done a lot of historical, data analysis on, is, different sectors, different types of tokens across the markets. How do they perform on a risk-adjusted level, not only relative to Bitcoin, but just in general, relative to any liquid asset class out there, stocks, commodities, you name it, asset classes we spent a lot of time in our past lives. Meme coins have the best risk-adjusted returns of pretty much any liquid asset, sector, class, you name it, that I've ever seen. Obviously, that if you get one of the ones that skyrocket and actually make it, if you miss those, then maybe not so much. And so we generally avoid shorting anything in that. The shorts that we look for are not, small market cap scam tokens or meme coins or anything like that. Those we put in the higher risk bucket for, very strong parabolic short squeezes. The stuff that we're really shorting, and again, very diversified, is more of the stuff in your top 200 that, assets that we think are past their primes. They've lost in the category that they're competing in. They have that low float, high FDV, lots of VC dumping, things that mathematically it's hard to see them keep up with Bitcoin or keep up with our long portfolio on the other side. And, we're just, I'd say, very maybe thoughtful or very careful about what we put into that short basket. And, and then we keep it diversified, and you have to have stop losses and all that stuff, of course. But it's the stuff we're shorting is not necessarily the stuff that maybe short-term oriented traders are shorting, right? That where they do a little bit more timing around their shorts and everything. We just think the risk is too high for a lot of those things. If anything, meme coins probably better on the other side from a risk-adjusted level, at least for our strategy.
Isn't that extraordinary? I've never heard the term meme coins represent a good risk-adjusted return before. Never heard that phrase.
We let the numbers tell us what the truth is, and then we try to build around it.
So, Andrew, but all ships rise on a rising tide in this space. And, shorting a fairly old blockchain that really no longer has the community that's sitting on it, we find that it rises in a rising tide. But are you saying essentially you're shorting past that period? You don't mind. The tide will rise for a month or so, or 2 months, and then you're short past that period. Is that the difference in you shorting some of these tokens that, to a degree, follow the beta of the market?
Yeah, so we call our short evergreen shorts, right? Because the shorts are always on. A lot of our shorts are the same shorts we've had on since inception, a year and a half ago when we launched this flagship. So our goal is to always be hedged, which means you have to have shorts on there at all times as long as you have longs. And we're always 100% invested, right? We make money, or our goal is to make money by the longs outperforming the shorts over time, whether that's, consistently month to month, or in, spikes of volatility where you have one long that just goes crazy and obviously well outperforms the short basket in those scenarios. And so it is a longer term oriented strategy. That's probably what's most unique about our process. And I think a lot of people think we're crazy for that. I think if they saw the numbers and actually looked at how we do it, it would make a lot more sense to them. But we all agree that most of these tokens are price losers over time, or at least they're going to underperform most of the other assets that people like in this space. And so to us, it's crazy not to have shorts on. So you're right. In rising markets, our shorts, we expect them to take on some unrealized losses over time. Now, if you're using perpetual swaps, the good thing is most of the market is on the long side, so we actually get paid funding rates to be holding those shorts during that time. And some of those yields can be incredible over time, just being on the opposite side of the market, taking a contrarian approach. But yes, we don't mind the shorts losing a little bit in the short term or during bull markets, whatever, because our longs should be outperforming them anyways, and that's generally how it's been so far. But it's really through cycles, right? When the bull market is over and things go the other way, and you never know when that's going to happen, that's when, through a full cycle, I think it becomes very apparent, the alpha that's produced between the longs and the shorts, especially when you have both the long portfolio in the green and also the short portfolio in the green. And that's what we've seen with our strategy so far.
Yeah. And have you taken profits when your shorts have shown very solid profits, or even when your longs are showing profits that you think is potentially in the short term outsized, with the intention maybe of re-entering that investment at a later date? Have you taken profits, or is it just simply a lock and hold on both?
Yeah, generally speaking, our rule of thumb is, do good research. And when the research says the valuations or relative valuations to, other things in the asset class look a little high on the long side, it's crazy not to take profits. Look, no matter how much I think something, maybe the future Amazon or Google of the space, if it goes up 10x within a week, it's crazy not to take advantage of that, because we know most of crypto, the markets today, is very short-term, trader-oriented, TA-driven, quant-driven. And our goal was to not compete with those people. We said, let's compete more on a longer-term basis. Everyone else in the market will fight on the short-term level. And then the market will present us opportunities to take profits or enter new positions when the spikes go in one direction or the other in a very significant way. By always being hedged, we can sit there and wait and be patient and let those kind of fat pitches be thrown to us, and then take advantage of it opportunistically without having to compromise any of our net exposure risk or anything like that, because again, we're always hedged. And I think that's just a style that we're more maybe comfortable with. Obviously it fits our backgrounds and experience and everything, but it's a style that we don't see many people doing in this space. And that's exactly what I want to see, is you have to be differentiated to get an edge in any market. And if we're doing the same thing everyone else is doing, then there's probably something that needs to change.
Yeah, 100%. Look, it's fascinating, Andrew. Really appreciate your insights to this. I think the audience should be able to see from it that the maturation of this investment class is happening every day. And your Black Lotus and that strategy is an example of the maturing of the asset class. The determination there are some great assets to be held here, and how you navigate through what is clearly a volatility asset to be able to maintain and benefit from them. And like I said earlier on, to be different to all those others that are following the same path of the marketplace over that period of time. Andrew, fascinating to meet you. Great to chat with you. If anyone wants to connect with you, of course they can. And what's the best way to connect with you, Andrew?
You can find me on LinkedIn. That's probably the best place. Just send me a message on LinkedIn. I was going to give out my email, but yeah, LinkedIn is perfect and we're pretty responsive. So yeah, please reach out to me, whether it's just for educational purposes or others. We love networking with people across the space. There's plenty of smart people. We spend a lot of time crowdsourcing ideas and research as well. Feel free to reach out anytime.
Brilliant. Thank you so much indeed. Look forward to seeing you, and hopefully in a year or so we'll get back together again and talk about the market of where it's up to at that time. Andrew, excellent. Bye for now.
Thank you. Take care. Bye.